Hi everyone, this is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a former Wall Street bond trader. He's a gold hedge fund manager. He writes the Mining Stock Journal and the Short Sellers Journal. He writes the popular website Investment Research Dynamics, also articles on the real estate market on Seeking Alpha. And he's the co-host of Shadow of Truth with Rory Hall of The Daily Coin. Dave Kranzler, thank you for joining me again.
Thanks for having me, Jason. It's good to be back on your show.
Yes, and you're back a lot sooner than I thought because yesterday's audio got totally trashed. So hopefully we're going to make sure that this thing comes out A+ and perfect this time. And we're going to get right down to it as quickly as possible. So, Dave, a lot of hedge fund managers right now, even The Economist magazine, which is basically like Captain Obvious, is asking a question in last week's magazine cover that there's a bull market in everything. Do you think everything else is in a bubble right now except for gold and silver?
I think anything that's looks like it wants to move higher is in a bubble, and it shouldn't surprise anyone that there's a massive asset bubble going on. Some apologists for the quantitative easing program, which is really just outright money printing. They'll say, well, look, there's no inflation, so, the money printing didn't cause inflation. Well, that's not true. There's a lot of reasons. There's a lot of structural economic reasons why we haven't seen rampant food inflation, but there's been plenty of inflation in a lot of other areas where people have to spend money every day. But set that aside. A lot of most of the cash that's kind of sloshing around, and a lot of that cash is in the form of credit that's been issued but not repaid, and most of that cash has been just flooding into the stock market here, in the U.S. and globally, and it's been flooding into the housing market. For as big as the housing bubble is in the United States, England just got through with a massive bubble. And theirs is starting to crack pretty quickly. A friend of mine was just over there recently, and they were just horrified by the number of for sale signs they were seeing, especially along the southern coast of England. And one of my Short Seller Journal and Mining Stock Journal subscribers lives in outside of London, and he can testify to that. The last two times we had real estate bubbles in the United States, which would have been the mid-90s, which was sort of a mini bubble, and then the one that culminated in 2008, the trend in England tended to lead the U.S. by 6 to 9 months. So their bubble popped before ours, but you got bubbles all over the world. People that I talked to in Australia, I mean, there it even makes the Toronto and Vancouver bubble that is now popping, look somewhat tame. So, it's essentially what I would call an everything bubble. Rare art, collectibles, collectible cars, all of those. It's people are just looking for things to throw this cash into. That might increase in value. And where we are with the stock market and the housing market, and I've written about this and backed it up with data, especially with regard to housing in my Short Sellers Journal, is that the only reason people are buying stocks right now is under the assumption that someone else is going to come along and pay them a higher price. And definitionally, that's how you define a bubble.
And that's the greater fool theory, which a lot of Wall Street people like to laugh at people that do that, and yet they're doing it themselves. A lot of them are career risks, though. So if you're a hedge fund manager and you're not participating in this bull market in bonds, the stock market rally, you're risking your career. You're risking all your assets under management getting fired if you go to cash. So a lot of guys who have left the hedge fund business and are out of professionally managing money in their own personal portfolios, they're not investing in these markets. They're going more to cash. They're going short more markets. They're adding, increasing their gold exposure. But to add to your points there, I wanted to go in depth though for our listeners about the different asset classes that are in bubbles. So you talked about the stock market, Dave. I think this is one of the 4 most overvalued stock markets of all time, depending upon which valuation metrics you want to use. It's definitely up there with 1929, 1999, 2007, and present. You've talked a bunch of articles, Dave, about the share buybacks. There's, I think, well over $1.4 trillion that corporate America, the large publicly traded stocks like General Electric, which bombed earnings, totally bombed earnings recently, and then the stock dropped only like 6%, and then it ended up in the green again at the end of the day. So, without this artificially cheap debt, and this cronyism and accounting fraud and financial engineering, I don't think the stock market would be nearly as high. There's a lot of passive investment money that's come in index funds too, from dumb retail money chasing these higher highs. Dave, with the S&P 500 index, I think I read somewhere that 90% of the S&P 500 companies are now below their 200-day moving averages and are in bear market territory, and yet only 10% of all the total companies out of the 500 are dragging this index higher. Those are the FANG stocks, right? Facebook, Amazon, Apple, Netflix, Google?
Yes, that's correct. I wrote about that, I don't know, about 6 weeks ago, I think, in my short sellers journal. And as it turns out, it's just increasingly a smaller and smaller number of stocks are pushing the market higher. For instance, when the Dow jumped 150 points 2 days ago, IBM was 100 points of that, and Goldman Sachs was 45 points of that. So you had two stocks who were responsible for 145 points of the 150 or 155 point move, whatever it was. I don't remember exactly. So I just wanted to circle back really quickly to the current valuation of the S&P, and it's actually the most overvalued market by several metrics. And even if you take, everyone uses Shiller PE now for whatever reason, but if you were to go through the exercise of adjusting the current S&P trailing earnings and use the GAAP accounting standards that were in place in 1999, I would suggest, I'm 95% confident that you would adjust those earnings. So what would happen is the current trailing earnings would be adjusted downward by probably 30 to 40%, because that's how liberalized GAAP accounting has become. I'm 95% confident that the PE ratio now on that basis, on a GAAP accounting apples to apples basis, PE ratio now is much higher. Now, if you threw out all of the companies that don't earn money, because a lot of the companies in '99 didn't even earn money. They're tech companies that were losing money hand over fist, which skews the earnings number. If you throw out the companies that don't earn money, then I don't even think you need to do the GAAP adjustment. But if you do the GAAP adjustment, the PE ratio right now would be much higher. And then you can also, the other one that I think is an even better metric is look at price sales ratio. And the median price sales, the PE of the median, or the median price sales ratio for the S&P 500 is significantly higher than it was in 1999. And the reason you would use sales is because sales are what they are, except for Tesla, which even fraudulently accounts for its sales. But the reason you use sales is, the further away from the revenue line that you get, the more accounting games GAAP accounting games affect the numbers below sales. But the revenue line is what it is. So that's essentially an apples to apples comparison between now and 1999.
And so I agree with you. I think Dow 23,000 is a total joke. I think it's misleading. I think, there's so much central bank money and credit sloshing around, whether it's from this China credit bubble that's exploded since they did their stimulus package, or currency swaps from central banks, well over $18 trillion of money and credit sloshing around the global economy. I actually haven't seen anyone try to back out all of those share buybacks with debt, the artificially cheap debt over 1.4 trillion that these large cap publicly traded companies have done to goose earnings higher. If someone actually removed those, I think it would be an even higher price to earnings ratio than that 30 to 40% increase that you said. I think we could be looking at potentially 50% higher PE ratio or higher.
Yeah, absolutely. And ordinarily, I would say it's probably, the share buyback thing kind of clouds the issue. And I would say if companies were just buying back their shares out of cash, I would say, well, then, you know, you don't want to add back the share buybacks. I mean, to me, that's legitimate. I'd rather see these companies pay that cash out as a dividend and let the shareholder decide what to do with that cash. However, most of these companies are taking out debt. They're issuing debt, or they're not paying down debt and using the cash to buy back shares. So on that basis, you'd probably want to look at enterprise value multiples, because if you look at market cap of the equity plus debt and do that as a ratio of earnings, I would say earnings or even revenues. The cash flow number is a BS number, but you know EBITDA is a BS number, but do that as a multiple of revenues. You know, again, I'm willing to bet that the valuations on that basis are significantly higher than they were in '99.
Yeah, I agree with what you said there. And so I think the stock market, you know, maybe it goes higher, but it's obviously not going higher in any fundamentals. A lot of these corporate executives are only doing this. They're not doing this for the long-term benefit of their shareholder. Maybe in the short term, it makes shareholders happy or stock traders happy who are trying to get fast money gains. But in the long term, you know, they're not creating new products or services. They're not adding long-term value. They're actually saddling the company with more and more debt, larger and larger interest expenses. Look at ExxonMobil's interest expense, how much it has increased. They were doing share buybacks when their stock was much higher. Look at General Electric, how the company's now saddled with enormous amounts of debt. Same thing with IBM. If I want to talk about some of the other asset classes, so the bond bull market that's continuing, Dave, the European Central Bank, their quantitative easing program has exploded. Their balance sheet is now larger than the Federal Reserve's at over $4.7 trillion. Their publicly stated balance sheet, let's just say. And, you know, one thing that's scary to me is European junk debt. We now have yields for European junk debt, private sector, pricing in lower risk, lower yields than U.S. Treasuries. That's totally insane. That's the type of distortions that whether it's the Bank of Japan, the European Central Bank, the Federal Reserve have done in all these different asset classes.
Again, I wouldn't be surprised if the Fed is doing you know, extending credit lines to, you know, to help the European Central Bank and the Swiss Bank, you know, manage their balance sheets. They do these swaps, and it's one of the reasons why the Fed fought so hard to extinguish the audit the Fed bill that Ron Paul tried so hard to get going. The Fed spent millions to get that legislation out of Congress and killed. But yeah, the fact I saw that statistic the other day about the European junk bonds, and you know, quite frankly, I was a junk bond trader in the 90s, and I'm just horrified at the yields that even CCC paper are trading at in this country. And again, it's as you said, it's the massive distortion to the capital markets that has been created. It's not just Federal Reserve or central bank money printing per se, but it's also their direct interference in these markets.
Yes, and it's creating unintended consequences because then market participants are then piggybacking some of these trades that the central banks want to do, are colluding and intervening with. So then you have, whereas the central banks have tried to prop up the stock market, you then have hedge funds, investment banks, you know, even day traders doing this leverage short volatility trade, which wasn't a large trade initially, but now, Dave, according to hedge fund manager Christopher Cole of Artemis Capital, this trade has ballooned now to over $60 billion in direct exposure and over $1.5 trillion in leveraged short straddles on the VIX, on the volatility index, and other major stock market indices like the Dow and the S&P and the NASDAQ.
Yeah, don't even get me started on this VIX thing, because I mean, when you think about how perverted it is, how perverted our markets are, that you can make a bet on the volatility of the markets. I mean, the function of the capital markets is supposed to be to efficiently allocate capital from those who have capital to those who need capital. making bets on the direction of the stock market or the direction of the volatility of the stock market is insane. It has no part in helping the capital markets function efficiently. It's a derivative. It's a derivative bet of a bet on the stock market. So when you're using derivatives to bet on the VIX, you're using second order derivatives. It's just crazy.
Yeah, it's become, to add to your point there, it's become a casino rather than, the initial purpose of the capital markets, and it hasn't been this way in decades, Dave, for the most part. It initially used to be to, if a company wanted to build a new factory, and that would add value to the real economy, that would create new jobs, maybe new products or services, things like that. To a large extent, the capital markets don't really do that anymore.
No, not at all. And again, all this money that's betting, betting against the, betting on low volatility, or taking the other side and betting on, sudden high volatility. It's just another. It shows just how much money is sloshing around from the central bank money printing. And let's put it this way: if you didn't have the ability to throw money at the VIX because the Fed didn't print that money, the capital markets, stocks themselves would be, the market would operate more efficiently, because people would have to be more cognizant of the risks that they were taking. They'd have to get back to doing good old-fashioned analysis, and that doesn't go on at all anymore. I mean, it's all just computer algorithms deciding which stock to throw money into based on which one's moving that day. Oh, and guess what? I'm going to hedge it by taking
yeah, trade dollar yen and then short gold, depending upon which way it
or
moves.
go long. I'll go long the VIX to hedge my long position in stocks. I mean, it's nuts.
Yeah, and it's not just the Federal Reserve and the European Central Bank. I mean, China has created an enormous credit bubble too since the 2008 financial crisis. They did an enormous stimulus program. They have 220 trillion of liabilities listed on the People's Bank of China website. So, and all that money hasn't stayed in the country. So I think a lot of that money, if you're a Chinese small business owner and you have cash in your account, RMB in your account, and the Chinese government's going to devalue the currency or increase capital controls or something, you're going to go buy physical gold. You're going to go put money into Bitcoin. You're going to go speculate on some of these altcoins. And I think that's what's been happening, driving some of these asset prices higher. You mentioned the real estate bubble. I think a lot of money has left China in the last 10 years, maybe even more than that. Longer than 10 years, and it's gone to real estate in the United States, it's gone to properties in London, it's gone to all over Australia, and also to Vancouver and Toronto.
Yes, there's no question about that. And it kind of reminds me of the 1980s when the Japanese were in a similar position as the Chinese, and they were speculating recklessly on real estate all over the world, especially in New York City. And I remember the Japanese high-ticked the market back then when they paid like an ungodly amount for Rock Center, and they ended up selling it, a few years later at a huge loss. All that's going to happen again at some point. I just don't know when.
Yeah, and they overpaid for, I think, Pebble Beach golf course as well. And I think like one tiny square foot in Tokyo cost as much money as one point as an enormous amount of the state of California. It was some ridiculous amount, and it hasn't been that way in 30 years. And the Japanese stock market now is actually at a 20-year high, although it's nowhere near what it was 30 years ago, but it's still at a 20-year high. And that's because the Bank of Japan, Dave, is also rapidly expanding its balance sheet. They've done even more QE the last few years than the Federal Reserve has. Their balance sheet's over 4.5 trillion. And I think the Bank of Japan is one of the largest, if not the largest, holders of Japanese stocks and ETFs in the country. So not only are they monetizing debt, owning lots of Japanese government bonds, they also own now a large percentage of their stock market because they don't want their own stock market to crash.
That's right. I think the statistic I saw on the Japanese central bank is that it owns something like, I don't know, 70 or 80% of all the ETFs in the country.
This is dystopian. I can't even believe we're talking about this. If you would have told me that the central banks would have created this much money and credit in 2009 and 10, when I was, waking up, learning how bad the system was, I would have been shocked that they wouldn't have been able to get away with this without letting any of their currencies collapse. And yet, the amount of collusion, Dave, that these large central banks are doing to keep their exchange rates from collapsing must be insane.
Oh, absolutely. Like I said, they're all doing, currency swaps with each other. I mean, that's part of how the dollar yen is used to manipulate the price of gold.
Now, I want to transition to the Federal Reserve. In your opinion, can the Federal Reserve actually sell $100 billion or more in assets off its balance sheet? And who could actually afford to buy these assets if the Fed is serious about selling them?
I'm not sure the Fed is serious about selling the assets. I think it's kind of jawboning. It's like their threat to raise interest rates. I mean, since Bernanke made his famous speech in May of 2013, that was when it was basically interest rates were, it was basically zero. We sit here, what, 4 years later, almost 4.5 years later, and interest rates are, what, at 1.25% or something? It's been so many 1/4 point hikes, I've lost track of exactly where the Fed funds rate is, but let's just say it's 1.25%. I mean, that's not really a rate hike. You're talking about before the 2000 or 2008 crash, the Fed funds rate was at 6.5%. If they tried to raise Fed funds rate, even if they did it over the course of a year to 6.5%, you would cause an economic black hole in this country. So they can't raise rates. The 25 basis point hikes are kind of face saving, and I think it's also been done to try and help keep the dollar propped up, just to sort of keep, the dollar's been trending lower for quite some time, but I think it would be a lot lower if the Fed wasn't at least talking about raising rates and talking about shrinking its balance sheet. They said, I think the game plan is to kind of let the securities mature and run off. Well, that'll take forever for that to happen. I don't think their intent is to actually auction off assets or repo them back to the banks, because again, if they did it in meaningful chunks, like $100 billion chunks, it would collapse the system. And quite frankly, and I have the numbers on my blog, and I don't remember them off the top of my head, but it's something like, with $4 trillion in assets, if they were to bleed off 500 million a week, it would take 40 years or something like that for them to get their balance sheet, quote unquote, normalized.
And all these hedge fund managers, Dave, a very high percentage are betting on strong dollar anyway. So, I mean, that was the overcrowded trade earlier in the year in late December and January, as Trump was winning there. Everyone was betting on strong dollar. Then the dollar index had a huge correction, more than 10% move, which for a currency is pretty large. But yeah, I think there's, in terms of the $100 billion chunks, I think there's only a handful of entities who even have the capital to buy them. So I don't think, the talking heads on mainstream financial media are bringing up, they're just placating to the people in power. They're not, holding their feet to the fire, saying like, well, who would buy what you want to sell? Because there's not a lot of entities with $100 billion. I mean, I could name some of them right now. So there's other central banks, but I don't think the People's Bank of China is going to do the Federal Reserve any favors. There would have to be, an extra pound of flesh or something in there. In order to get them to agree to do it. I mean, they could obviously do more currency swaps, but, if they keep doing these things, eventually we're going to maybe find out about these things. There's maybe pension funds, but I think they're already overloaded with treasuries, and, their returns are bad. With record high asset prices, they're enormously underfunded, and there's decades that going forward, there's an enormous unfunded pension fund liability crisis for future generations. Maybe the Fed can trick the primary dealers into buying more of them and then buy them back under the table in the secondary market. But that's already been going on to a certain degree, Dave, for at least like 10 or 15 years. And then, there's the large globalist, there's exchange stabilization fund, which, there's no accountability whatsoever. There's no transparency at all. We don't know, any major details about that. And then there's the main globalist organizations that, manipulate markets and, over in debt emerging markets and things like that, like the IMF, World Bank, and Bank of International Settlements. So there's really not many entities who could even buy over $100 billion in assets, even if the Fed wanted to sell.
Yeah, I don't know. I haven't heard that they were looking to do, 100 billion at a time. If the talking heads on TV are saying that, they're just reading the script that's put in front of them. It's going to be interesting to watch because, again, I think the plan is just to let the stuff mature off, and that'll take forever. And I don't even think they'll get very far on that because at some point the inertia, the kind of economic inertia below the top 1%, and when I say below the top 1%, it's basically the middle class. Middle class is hurting, and it's going to get worse. And at some point, there's going to be a complete collapse in demand from the middle class, and the Fed's going to have to juice the economy again, or faux juice the economy with printed money.
Exactly about the middle class, I completely agree. I think, this central bank intervention, Dave, all this asset price inflation, it really hasn't benefited the guy on Main Street, the middle class, because most people in the middle class don't own a lot of assets. So maybe, they own their own house, and maybe they have like a small 401k or IRA, but there's not a lot of people who own a very large bond portfolio, a very large stock portfolio, and a bunch of, commercial real estate investment portfolio and rental properties and things like that.
No, the average household out there barely has any savings, and to the extent that they have exposure to the stock market, it's in an IRA or a 401k, and who knows if they'll ever get to see that. And when you say they own their house, well, if you put 3% down on a house and you're mortgaged up at 97%, and by the time you close, you're underwater because your cost to close and move is greater than the 3% down payment you put. You don't own that house. You're basically a long-term lessee from a bank.
Those are good points. I actually want to ask you more about the housing market since I know you've been writing articles for years about this on both your website, Investment Research Dynamics, and also articles for Seeking Alpha. So do you think these regulations for Dodd-Frank have caused unintended consequences with the large banks? They decided that they didn't want to go through all the different hoops that were put out for derivatives trading and stock market trading with high frequency trading algorithms. They've cut back on that business, and instead they put a lot of money into commercial real estate lending in the United States.
Well, I think that in general, again, all the money that the Fed's printed has bubbled up residential real estate and commercial real estate, and a lot of the big banks kind of started pulling away from lending to residential homes, just because it wasn't that profitable and they didn't want to take the risk. I know banks like JP Morgan started to cut back. But I would just throw commercial and residential into the same bucket of it's been massively inflated by the Fed. I mean, the Fed printed up close to $2 trillion and it bought mortgage paper in the form of agency debt from Fannie and Freddie that was issued that the Fed bought. So that gave Fannie and Freddie money to lend to the housing market, and then it directly bought mortgage pools. So anyone who thinks that this housing market is a function of organic economics is insane, because it's completely a function of the $2 trillion that the Fed's dumped into the real estate market. And commercial real estate, for whatever reason, I think it's easier to get large scale lending for that, because insurance companies, pension funds, and large banks are willing to lend against large commercial projects, and it's created a massive oversupply in commercial real estate. Multifamily housing, it actually falls into the commercial real estate bucket. So I know most major cities are facing a glut of multifamily buildings, especially in the urban areas. The suburban areas are quickly catching up. When I drive around Metro Denver, I see it wherever I go. Massive apartment projects going up that'll never get rented out. And obviously, the so-called retail apocalypse is going to just hammer the commercial real estate market. But it's the same is true for office buildings. I mean, Denver's probably had, I would say Colorado's probably had the largest influx of population of any state in the country over the last 5 years. A lot of it has to do with the pot laws here, but I mean, there's a lot of reasons why it has. And I mean, there's still a massive glut of office space and retail type, and commercial business space. So if there's a huge glut here, there's a huge glut everywhere.
And to add to your points there, I see basically the same thing, boots on the ground here in the Washington, D.C. metro area. There's like nonstop construction cranes, whether it's downtown D.C., either renovating old luxury hotels or building brand new ones. They're building new like mixed-use luxury condo buildings. There's certain height restrictions here in downtown DC, but in Northern Virginia, they're building, nonstop luxury townhouses, luxury condos within, 15, 20 minutes of DC. They're even building enormous amounts of large townhouses and luxury homes, single-family homes, 45 minutes an hour further and further away from DC. And then they're building like all the infrastructure there with, schools, roads, basically come out to Ashburn. If you want to film a documentary, this would actually be a good documentary to show how big the housing bubble is here. DC was pretty insulated, though, compared to a lot of the other cities during the 2008 financial crisis with the housing market. I think there was only about a 10% drop in housing prices here. But yeah, so the evidence we're seeing, though, is with, just enormous, basically nonstop construction of all different types of real estate. But also the other evidence I see, and we were discussing this yesterday, was I see a lot of evidence, Dave, that the consumer, and this area is supposed to be affluent. There's 3 of the 5 richest average median family incomes here. The consumer doesn't have discretionary income to go out to eat at, especially middle class, casual dining chain restaurants Monday through Thursday. Those restaurants, those parking lots are totally empty for lunch and dinner. Movie theaters, as soon as a movie comes out at a major new movie theater on a Friday night, these movies are empty. I've seen this, for months. This was during the summer with big name movies that supposedly made well over $100 million the opening weekend here in the United States, and yet the movie theaters here in my area were empty. So I think there's a divergence here between asset bubbles and reality.
Yep, there's no question about that.
Well, I want to transition now to gold, the gold market. The gold market just keeps getting hammered, whereas Bitcoin just keeps soaring higher and higher, and all these other cryptocurrencies. Do you think a lot of money that would have went into gold, silver, and mining shares is instead going into Bitcoin, Ethereum, these altcoins, and those instead?
That's an interesting question, and I did an article with Paul Craig Roberts probably about 6 months ago, where we hypothesized, might have been a little bit longer than that, where we hypothesized that a lot of the money that was going into Bitcoin and the cryptos was taking away from the flight to safety money that would have otherwise been going into gold and silver. And while that might have been the case, maybe a year ago or 6 months ago, I think right now the cryptos and especially Bitcoin have kind of taken on their own, again, I just call it, bubble inertia, where people are piling into it just because the price is moving higher. And there's a fear of missing out. So, the price goes from 4,000 to 5,000. Oh, I don't want to miss out on the move to 5,000 to 6,000, so I'm going to pile into Bitcoin. I mean, the fact of the matter is, I'm not 100% convinced that Bitcoin is going to be capped at 21.5 million coins or whatever whatever the cap is. I'm not convinced that it's going to be capped, but even if you can cap each individual crypto, you can create an unlimited amount of cryptos. And so in that sense, the cryptos share a similar trait as fiat currencies. Again, I think that sort of the hysteria, bubble hysteria, psychology of mass crowd investing has engulfed the cryptos, and I think that's what we're seeing. And I mean, it's probably taking some money away from money that would otherwise be going in gold, but I think more likely it's taking money that might otherwise go into tech stocks right now. And I just wanted to come back to the comment that gold keeps getting hammered. I mean, if you look at a chart of gold just for this year, and you can run this chart all the way back to December of 2015, gold's in a beautiful bullish uptrend. And at some point, and it may take, the markets finally starting to roll over and sell off and ultimately like avalanche into a crash, which will happen eventually. But at some point, it'll be gold and silver's turn to be the investment where the price keeps moving higher, and the smart money at that point will already be in, and then you'll have the idiots who are chasing price momentum will all of a sudden decide to chase the price momentum of gold and silver. I mean, that's kind of what we saw when gold ran very quickly up to 1900 in 2011, and silver ran very quickly almost up to 50.
Yes, and the gold and silver, primary gold and silver miners are also in the near future, next few years, less than 5 years, I would say, are also facing, somewhat of a crisis where, according to hedge fund manager John Paulson, they've written off over $85 billion in bad deals, malinvestments, bad acquisitions since 2010. Enormous amount of money, enormous amount of waste, and yet, despite all that capital that's been wasted, they still don't have enough economic reserves to replace, mine production that they have and replace reserves adequately. So something's going to have to give here in the near future. Maybe, the manipulators will figure out a way to reduce demand. I think demand from retail people in the U.S. and Canada, Dave, looking at the mint numbers for the most part for physical gold and silver, has basically collapsed. Some of my listeners have told me, basically since January that they've liquidated all their gold, silver, and mining shares, and it's not just one or two people who have told me this. So I think, the sentiment, especially for the Western people in the United States, the sentiment is extremely, extremely bearish. As a contrarian, that makes me good. But I see, large demand for physical metal from people in China and India. And the Russian central bank, of course, besides, this crypto ruble stuff, they're buying a lot of physical gold.
Sure. And, I don't really even pay attention to the mint sales numbers, because the retail coin buying is like, it's a flea on the back of an elephant. It's minuscule compared to the overall volume and amount of gold that's being hoovered up by Eastern Hemisphere countries, especially and specifically China, Russia, India, Turkey, Vietnam, and there's a few others that you can throw in there. All of those countries that are kind of along the Silk Road have been buying a massive amount of gold relative to the size of their central bank's reserves. So to circle back to what Paulson said about the mining industry, I mean, he's specifically referencing the really large mining companies like Newmont and Barrick. And, to throw that out there pejoratively about the mining sector is ignoring all of the write-offs that aren't happening in corporate America in general, and that will happen when the stock market comes back down to earth. So I don't pay any attention whatsoever to what Paulson does in the gold precious metal space, because I don't think he's done a very good job with managing it, and he primarily only invests in the large cap miners, and those are the ones you don't want to invest in. So beneath the surface, there's a whole universe of emerging producing mining stocks and mid cap mining stocks and junior exploration development stocks that are just incredibly undervalued. They're very well run. Most of them are run by really, top-notch geologists that left companies like Newmont and Barrick in the 90s and went out to stake their own claims. So to me, that's where I see the real opportunity in the precious metal sector and in the mining stocks is in the smaller cap producing stocks, the emerging producing companies, and in the junior exploration companies that have really good projects that are being advanced and de-risked. And when the Barricks and the Newmonts of the world get their balance sheets straightened out and the price of gold is approaching 2,000 and they're just printing cash flow again, they're going to once again they'll overpay for these juniors. So that's what I'm setting up for.
Yeah, I think they'll overpay too because that's what their track record is. They rather than take risks in the bear market part of the cycle in the value phase, we don't see a lot of that right now. So we instead see people are trying to fix their balance sheet. They're trying to do maybe a little bit of exploration on an existing mine. They don't want to go out and buy a junior, even though they probably should when sentiment is bad because it'll cost them less money. But the CEOs would rather overpay for it later on. So unfortunately, I think that's if you're an investor in juniors, it's good, but I'm not sure if it's entirely healthy because that's what the industry did with all the write-offs at the top of the market before the paper bear market started in 2011. I prefer the sentiment for U.S. retail investors. A lot of them, Dave, have told me they've sold their junior shares too. So maybe that's a contrarian indicator as well. But I actually like the royalty and streaming companies because if the paper bullion manipulators are able to cap the prices a little bit more, those guys have the good balance sheets, the big five royalty and streaming companies, to go and do the deals for cash flow. So if the gold and silver price don't rise, they'll have the cash to go and do more deals for cash flow, and later on that'll be long-term value creation. Because the whole thing, with investing in cyclical businesses is you're supposed to be a contrarian. That's what Rick Rule says. But in practice, most of these companies, the large ones, like you said, are not contrarians with their investments. So they're not buying quality assets at the bottom like you can if you're an investor or a royalty and streaming company. And I think that's why the industry has been hurt because it hasn't been contrarian enough.
I don't know about that. I mean, back in December 2015, the value of mining stocks in relationship to the price of gold was at an all-time low, and we had a nice run-up, and then we've had a pullback, and the mining stocks as a class are still extraordinarily cheap relative to the price of gold, especially the small-cap ones. So, again, I understand what you're saying about the royalty companies, and I think they're, for the most part, they're very well run. I like Sandstorm, but again, even Sandstorm ended up buying all of Mariana Resources. They originally were just going to do a royalty deal with Mariana, and I got my Mining Stock Journal subscribers into Mariana at about 82 cents in December, and they sold into Sandstorm at, I don't know, like $1.50 or whatever, $1.45 or whatever the number was, literally about 3 months later. So again, I think the key to making a lot of money in the junior mining stocks is to find the ones that have real deposits, have the cash and smart management that can advance these projects up to the point at which they're essentially shovel ready, which is what Mariana was. And whether it's a royalty company or a large cap company, someone's going to come along and buy them.
Yeah, that Hot Modern mine in Turkey, the geology on it is absolutely superb. That mine could, once it's built, the capex is low cost, high grade mine. That mine could run for 20 or 30 years, and there's a lot of other exploration upside on the property there. It's a very large land package, and there was also some mining done about 100 years ago by the Soviets, and it was further south in that area, so there could be a second or third mine there, potentially too, down the line. But actually, the Sandstorm, they didn't turn into a mining company. It's actually that contract with Mariana with the larger project owner is actually structured as royalty. I don't want to get into it too much, but it's actually, I've spoken with Nolan Watson about this at length. So there's a misconception there that they've turned into a mining company. They haven't.
Well, I'm not saying they turned into a mining company. I'm just saying they bought Mariana for stock and cash. How they structured it legally, I don't care. Oh, because I don't own it anymore. We did own Sandstorm for a while in the fund because at the time when this deal was announced, Sandstorm got beat up unnecessarily, and so we rode that stock from because I thought it was easy money just to buy it and hold it for a while when we were sitting on cash. So we rode that stock from. We got into it right at the bottom at like 320, and I ended up selling it most of it a little bit over 4.
Yeah, I really like Sandstorm Gold long term. I think they fixed the company since 2012 and 13. They have a lot of diversified assets now throwing off cash, and they have a very large silver stream coming online in the next 12 to 18 months. So it's going to be their largest source of revenue. And then they have the Hot Modern mine that'll come online pretty soon after that. So they could
Sure.
like pretend that the conservative estimates they have, Dave, are that once those projects are online, they're going to double their operating cash flow by like 2021. But I've seen more aggressive ones where at the current gold price, their operating cash flow could triple by then. So,
Yeah, well, hey, it's skin this cat a lot of different ways. I mean, I feature several stocks in my mining stock journal that have, say, 50 to 70 million dollar market caps that in the next 2 or 3 years are going to be taken over at 300 to 400 million dollar market caps. So that's kind of the way I look at the juniors that I like to follow.
Are you finding primary silver mines? Because it seems to me there's really not many of them left at the current spot price for silver. So at silver around 17, there's really very few potentially new economic silver mines at that price. Seems that a lot of the primary silver miners in the next couple of years, Dave, are going to need $25 to $30 an ounce silver at the minimum, new price floor in order to bring on new primary silver mines to replace their reserves and old mines that are going to be depleted.
Well, I think we will get a much higher price of silver, 3 or 4 or 5 years down the road. I mean, we could be looking at $40 an ounce in silver, and mining projects that require $20 an ounce to start making money are going to be they're going to be money trees. I've got 2 silver mining stock juniors that have it looks like potentially prolific deposits in Mexico. And so again, they're going to be advanced and probably flipped into a large producer. I don't know. One of them, I think, actually does have a plan to kind of start production. We'll see what happens there. And actually, I take that back. I've got 3. And one of them, roughly it's one of these ones that has a $50 million market cap right now. And this thing could easily be worth $300 or $400 million 2 to 3 years down the road. So the other thing I've done is there's a sort of a medium cap pure silver producer that was unnecessarily sold down during this latest pullback, and I featured that with a buy recommendation, and I said I anticipate or expect it to outperform First Majestic, which is everyone's benchmark in this, for pure silver stocks, and it actually has been outperforming First Majestic since August, and I had it in there in September, so if I ran it since September, it's outperformed it even more.
And you have a track record, Dave, of picking winning juniors. So you didn't just start this newsletter and you're hoping to get sales. You have I think you produced you made a 600% gain on one of the juniors. I think it was Silvercrest Metals. You already publicly disclosed that. That was the spinoff after after First Majestic Silver bought Silvercrest, right?
Yes, that's correct. And I think Silvercrest has a lot more upside. There's a copper gold project, and that's basically this company's sole project right now, although they've got some more. And this is a stock that I think could go from a $40 million market cap to a $500 million market cap if they have what I think they have there.
And the funny thing, I didn't know this until I saw at the Denver Gold Forum some of the presentations. The Santa Elena mine that First Majestic Silver bought from Silvercrest is actually their most profitable, highest margin mine now. So, considering all the mines that First Majestic Silver owns, it's pretty shocking that that's their best mine.
Well, and the guy who actually was the guy at Silvercrest Mines that developed the St. Helena mine. He's the guy that runs Silvercrest now, and I knew because we had a big position in Silvercrest Mines in my fund when it got taken over, and I know the management very well, and I kind of knew in a roundabout way that the CEO, the property that was spun off by First Majestic to the old management at Silvercrest, the Las Chispas property, I kind of knew that he thought that property was potentially multiples the size of the St. Helena property.
That's interesting.
Yeah.
Well, it sounds like an interesting speculation. So the thing about that, a lot of mistakes that retail investors tend to make, Dave, is they hear these stories and they hear the upside and they tend to put way too much of their own money into juniors. They're not diversified. So they put way too much money, into one junior or two juniors instead of being a little bit more diversified. But I could talk about this a lot. We're almost at an hour, so I want to thank you again for your time today. And if our listeners want to either subscribe to your newsletter or read more of your articles, how do they do so?
My website is investmentresearchdynamics.com, and I've got 2 links on there that can give you more information about either the Mining Stock Journal or my Short Sellers Journal. And if any of your listeners would like a sample copy, just have them shoot me an email at investmentresearchdynamics@gmail.com, and I'd be happy to send them a sample copy.
Okay, Dave. Well, I want to thank you again for your time. I always enjoy my discussions with you. And it'll be interesting to see, what types of new tricks either President Trump or Janet Yellen or whoever the Keynesian talking head comes after Janet Yellen is next time we speak.
I agree. Call me up anytime, and I'd be happy to come on your show. Thanks for having me.
You're welcome. And with Stanley Fischer already gone, I think, probably Mario Draghi and Janet Yellen and probably some other guys are going to be jumping ship as well. It's funny to see the rats, fleeing, saying, oh, I have this excuse, or oh, I have a book deal, or I'm going back to academia.
Well, they got to cash out.
Wall Street for Main Street needs your help. Since the middle of 2016, YouTube continues to increasingly censor and sabotage the growth and success of my channel with dramatically slower or no subscriber growth, a huge decrease in views per month compared to 2016, and well over $10,000 lost in Google AdSense revenues the last 18 months. I should have been way over 20,000 subscribers and way over 3 million views last year, but it feels like I am Sisyphus trying to roll a heavier boulder with more and more additional weight up a steeper and steeper hill. In the last few weeks, all of my videos have been set to demonetization by default, and I have to manually protest each video. This is in addition to even lower than usual Google AdSense revenues after the adpocalypse started over a year ago for me. This has also affected my ability to get paid advertisers to agree to deals not involving YouTube, as I lost $3,000 per month in paid advertising deals at the end of June 2017 because all my analytics are down a lot thanks to YouTube censorship algorithms that have intentionally kneecapped the growth of my channel. With YouTube/Google/Alphabet /Don't Be Evil strongly considering demonetizing or setting all libertarian, conservative, or pro-Trump content to private to prevent any sharing or monetization, it is imperative I have a contingency plan to figure out how to make a living off my content. Each 30 to 40 minute video takes a few hours of my time before it's released to the public. There's a strong possibility that in the near future, YouTube will force me to move all or almost all my content to a new video upload website that allows free speech or behind a paywall on my own website. Thanks if you have already made a one-time or recurring monthly donation, and thanks in advance for any future donations as I decide the future of my channel and what to do with my content going forward. We accept one-time donations on the Wall Street for Main Street website via PayPal, Bitcoin, or Gold Money. You can also become a monthly Patreon contributor for $1 or more a month if you want to help me out. And don't forget to like each video on YouTube and share it with your friends and family if you think they would like the content.